Now, making an investment plan involves more than just picking a few stocks to put your money into, because you have to consider your current financial situation and your goals. But it's also important to define your timeline and how much risk you're willing to take. Hey my fellow investors, this is Julius with another video of investing. On this channel, it's about everyday investors who try to invest in the stock market so that they can retire on their own terms. So today I'm going to look at why it's very important to have a plan before you join the journey of investing. Because most times we fail at investing because we don't have a plan in the first place. And that's why in this video, I'm going to give you my 5 steps for investing. However, as usual, I'm going to first ask you to join the journey of investing by subscribing below by hitting the red button and also hitting the notification. That way you won't miss any of my videos that I post weekly. Now let's begin with step number 1. Step number 1 is assessing your current financial situation. Now the first step in making an investment plan for the future is to define your present financial situation. You need to figure out how much money you have to invest, but at the same time you also need to figure out how much debt you have. And you can do this by making a budget to evaluate your monthly disposable income and expenses after emergency savings. Now this will allow you to determine how much you can reasonably afford to invest, because you don't want to invest money which was meant for rent, because that means when the time for rent comes you are going to have to borrow money, and 9 out of 10 when you borrow money it comes with interest. But it's also important to consider how accessible or liquid your investment need to be. If you might need the cash on your investment quickly, you could consider to invest in more liquid assets like stocks rather than investing in something like real estate, which is going to take a while before you can get this money out of your investment. Now, the next step in making an investment plan is to define your goals. You need to ask yourself a question: why are you investing in the first place? Because this can be anything from buying a car in a few years to retiring comfortably in so many years down the road. You need to also to define your goal timeline or time horizon. The other question is how quickly do you want money from your investment? Do you want to see quick growth, or are you interested in seeing investment growth over time? Now you can sum up your goals in 3 main categories. That is safety, income, and growth. What I mean by safety is when you are looking to maintain your current level of wealth. And income, this is when you want your investment to provide active income, especially when you retire. And then if it is growth, we can say is when you want to build wealth over the long term. Now you can determine the best investment path for you based on which of these 3 categories your goals fall into. Now the next step in crafting your investment plan is to decide how much risk you can take on. Now generally speaking, the younger you are, the more risk you can take, since your portfolio has more time to recover from any losses. But if you are older and you are planning to retire in the near future, you should seek less risk investment. And this is my humble opinion, because I don't see why you should be investing in a stock that you don't know where it's going to be tomorrow, and yet you are planning to retire in the next 5 years. Because at this stage, this is when you need to be preserving your income or preserving your wealth rather than losing it, because you don't want to be in retirement and you don't have any money left. And although risky investments have the potential for significant returns, but also have losses on the other hand, right? Now, taking a chance on an undervalued stock could prove fruitful, or could lose your investment. Now, if you are looking to build wealth over the years, you may want to choose a safer investment path, especially putting your age into consideration. Now, the next step is that you need to decide where to invest. Now, there are many different accounts you can use for your investing. Your budget, goals, and risk tolerance will help guide you towards the right type of account that you want to open up. You can consider securities like stocks, bonds, or mutual funds, or long-term options like your 401k plans and IRAs, or bank savings account. like CDs. Now, whatever you decide to invest, make sure to diversify your portfolio, because you don't want to put all of your money into stocks and risk losing everything if the stock market crashes. I mean, it does happen all the time. It's also important to allocate your assets to a few different investment types that fit with your goals and risk tolerance in order to maximize your growth and stability. And this is when you may seek professional help, because an advisor can help determine the best way to invest your money based on your current financial situation and goals. Finally, my last step, you need to monitor your investments. Now, once you have made your investments, it's not wise to just leave them sitting somewhere alone. Now, every so often, you should check on how your investments are performing and decide if you need to rebalance them. Now, for example, maybe you are not putting enough money into your investments monthly and you're not on track to reach your goal on time. Or maybe you are depositing more than you need to and you're ahead of your schedule. Or maybe you want to move your money to a more stable investment for long-term goals. Or maybe your investments are performing well and you want to take on even more risk to reach your goals on time. Now, it's important to go through the assessment steps that you follow to create your plan every few years to ensure everything is going accordingly and according to plan. Now, you should also make any changes or adjustments necessary to continue working towards your goals. Because at the end of the day, just like anything that you want to get good at, becoming a good investor requires research and experience. Now, if it's your first time investing, the experience will come later. So focus on soaking up information about the different types of investment that are available to you. You'd also take some time to consider all of the potential brokerages you could open an account with. Because when I began my journey, I was using just Robinhood. But then as I became more experienced in the stock market, I wanted to put some of my money in mutual funds so that I can diversify. And that's when I opened up Vanguard. But one thing I can tell you when it comes to investing for beginners, don't hesitate to ask for help from a professional financial advisor, because financial advisors typically specialize in investing and financial planning, making them great partners for that person who's just beginning this journey. You know, start investing sooner rather than later, because once you have an emergency fund in place and your debt in check, you can start investing, because the sooner you start, the more risk you can afford to take and the more investment growth you're going to experience. Now, as I mentioned above, a key to successful investing is not putting all of your eggs in one basket. An easy way for young investors to diversify is by investing in mutual funds or ETFs. So anyway, I've come to the end of the video, and if you like the content in this video, don't forget to smash the like button and consider subscribing by hitting the red button below. I know it's going to take you just 1 second of your time, but it will mean a lot when it comes to this channel. Thank you. See you next time.